Greetings and welcome to this launch of Rural Bank's Farmland Values report for 2021. This report and the insights it offers are a flagship activity on the annual calendar. Firstly, may I acknowledge the traditional owners of the land on which we all meet today, wherever we are in Australia. I pay my respects to elders past, present and emerging. I'm Lee Radford, former long-serving head of ABC Rural and someone who's been involved in broadcasting and specialist rural journalism for 35 years, heading up programs like Landline, The Country Hour, Rural Reports, Backroads and many more. These days I run a media company called Events on Air. But today's subject is right up my alley, you might say, as I'm as keen as any of you are to hear about the latest. Before we do that though, let me tell you a little bit about the format. Shortly we'll hear from three key speakers today: Alexandra Gardman, who is the Chief Executive Officer of Rural Bank, Matt Au, who's also from the bank, and Tom Russo from Elders. Now that's roughly the first half an hour, then it's over to you for questions. So throughout today's presentation, we'll provide the opportunity for questions to be answered at the end of the session. If you'd like to submit a question, please click on the question icon at the top right of the screen and type it in. If you want to be anonymous, just select the checkbox at the bottom. Now, if someone asks a question that you were also thinking of, that's great, just like it, and we'll discuss the most liked questions first. But now, to set the scene, let's go straight to the top with Alexandra Gartman. I've known Alex for years and she's a force of nature in the best of ways, involved in so many things, like being chair of the Victorian Agriculture and Climate Change Council, a member of the trustee of the Helen Macpherson Smith Trust, a director of the Australian Farm Institute, former CEO of the Foundation for Rural and Regional Renewal, the Birchip Cropping Group, and is currently the Chief Executive of Rural Bank. Welcome, Alex, and over to you.
Great, thank you very much, Lee. And how good is it to have you moderating this important discussion again?
I'm delighted to be here.
We haven't seen each other in person since the 2020 report was launched last year. So thank you very much for joining us. Like you, I'd also like to acknowledge the traditional owners of the lands on which we're meeting, and I'm on Dja Dja Wurrung country. But I'd also like up front to acknowledge the team who've put countless hours into researching and writing this report and bringing it to life and sharing it with the industry from today. Now, like you said, Lee, it's a really unique time to be launching a report like this. Farmland values are really front of mind everywhere, and there's a real buzz in the air with positive seasonal conditions, strong commodity prices and low interest rates. So there's money to spend and we're spending up big on farmland. Now, winter sports season has kicked off around the country, and the opportunity to gather and gossip on who's paid what price for what parcel of land, at least at those local games that I've attended in recent weeks. And it's not just farmers, but agricultural advisors and investors who are grappling with what many thought were impossible prices to ever contemplate. That certainly fuels some debate and discussion around the table at the Rural Bank Management Credit Committee, and when we're assessing the risk for lending for particular purchases. Is the level of debt per acre or hectare able to be serviced from the productive capacity of the business? And almost every single one of my farm conversations involves a discussion on where and when the next piece of land will be purchased and how that will complete or build out the future vision and strategy for the business. But, you know, recently I've had a few conversations with younger farmers looking for non-farm investment because they just can't justify some of the dollars required for that neighbouring property. So it's at times like these when the agricultural grapevine, pardon the pun, is running hot with anecdotes. And that's when facts matter. We need clear heads and robust evidence to understand the environment. We need data to underpin our decisions, and in this case, investment decisions. But I think data should underpin many decisions when running a business, particularly farm businesses. And that's why Rural Bank's Australian Farmland Values 2021 report is more important than ever. I'm particularly proud that Rural Bank takes the time to get into granular detail with every sale within official government agency data in each state and territory. Now, there's no doubt it's time consuming, methodical but vital work. We need unimpeachable facts for discussions with customers, with staff, our partners and the wider industry. And what about those facts? Well, the numbers really are exceptionally significant. The 2021 report covers 263,000 transactions over 26 years, accounting for 315.9 million hectares of land, with a combined value of $167.3 billion. So this year's report shows the median price per hectare of Australian farmland increased by 12.9% in 2020. And this is the 7th consecutive year of growth. It's actually the first time land has increased in every state of Australia. And the last time it did that was in 2005, 15 years ago. And when we throw our minds back 15 years, John Howard was Prime Minister, Makybe Diva won her 3rd Melbourne Cup, and Anthony Kalia had the highest selling single of the year with the Prayer, one that I don't remember. And some of the people on this call possibly may not have been in the workforce back then. I was actually working for the Birchip Cropping Group in the Victorian Mallee in the middle of the millennium drought. And that region and that event underlines the resilience of farmland values. The compound annual growth rate is strong by any measure. So over the last 5 years, it's 10.6%. Over 10 years, 6.3%. And over 20 years, it sits at 7.6% year on year. That is remarkably strong and consistent growth, and I look forward to unpacking that over the next hour. So, Lee, as you and others listen to the compelling data points that Matt is going to share shortly and Tom will dive into, I ask you to consider a couple of questions. One, is property overvalued or a reflection of our thriving, resilient, growing agricultural sector? Can we secure a return on our investment? And what happens when we consider climate change over the top of that? The report looks at commodity prices and land values. And is this a key indicator of where value has been and might lead? Thirdly, what is the likely impact if interest rates go up? Are our farmers over leveraged, or are equity levels at such that farmers are prepared for any inflationary event, something that Rural Bank is always considering, as you'd expect? And while strong land values are great news for farmers in the sector, what about new entrants? How can they get into the market, and what are the implications for succession planning? I'm sure that many of those on the call have more questions to ask, and I'm looking forward to the discussion in the second half of this hour. But also beyond today and more broadly as we work with the data and use it for industry discussion and action. So Lee, back to you, and I look forward to the next hour.
Thanks, Alex. And those top line figures are amazing. Quite an extraordinary time in Australian history, I think. So I'm very much looking forward to unpacking it and getting into the detail, because good information is what this report's all about. So to Matt Au, who is Senior Insights Analyst with Rural Bank. Matt grew up in Edenhope in the West Wimmera region of Victoria and studied at Marcus Oldham College in Geelong, where he's now based. Over the past 7 years, Matt's written and presented on a number of topics, including livestock, dairy, horticulture, and his pet topic, Australian Farmland Values. In 2014, Matt joined Rural Finance, now Rural Bank, as part of their Insights team, working on the original Victorian Farmland Values report. So now to the architect of this report. It's good morning to Matt Au.
Thanks, Lee, and it's my pleasure to present the 2021 Australian Farmland Values report today on behalf of the team. A reminder to those on the call that the report does use median price per hectare to track the growth over time across Australia, and the median is obviously the halfway point of the data set, so it's not a valuation of any one property. We calculate median price per hectare using total sale price inclusive of improvements. The reason why we use median and not average is that it's less susceptible to volatility caused by any individual transactions. So instead it relies on transaction volume to move up and down each year. We clean the data for outliers and remove errors and misinterpretations, leaving a data set of willing buyers and willing sellers, which in most states is above 30 hectares to exclude lifestyle segments. So the report's now in its 7th year of production. I've been lucky enough to work on every edition, and I can say that this one's probably the most anticipated that I've worked on, around what Alex was touching on before, that it is the first time in 15 years that all states have recorded an increase in median price per hectare. So let's jump into the results and see what we're looking at for the 2020 year. If we do a whip around the country, the 2020 calendar year in terms of farmland, it can be best described by three key themes: improved seasonal conditions, high buying power, and robust commodity prices. So if we take a trip around beginning in Queensland, where median price per hectare increased by 11.8%, and that takes the 20-year compound annual growth rate to 8.8%. So improved seasonal conditions and very strong cattle markets, particularly late in 2020, helped drive more activity among buyers. Median price per hectare in the west and central regions increased by 39.4% and 20.5% respectively, while in the north, median price per hectare actually eased slightly, but that's not a reflection of retreating demand by any means, but it's instead a reflection of increased demand for grazing properties up there in North Queensland, which traditionally sell for a lower price per hectare compared to other parcels of land in that state. Down to New South Wales, where growth of 15.6% takes the 20-year compound annual growth rate to 8.1%. Buyers were willing to pay a higher price to take advantage of newly listed properties, and that remains a really tightly held market in New South Wales across most regions. The western and central regions grew strongly with a 37.5% and a 25.5% increase respectively. That was followed by the high value southern and southeast regions increasing by 12.4% and 6%. In contrast, the northern region of New South Wales did record a decline, and that's a reflection of increased transaction volume in cropping municipalities to the west of this region, and that is largely on the back of more favourable seasonal conditions. Down to Victoria, where growth of 6.9% takes the 20-year compound annual growth rate to 7.2%. Demand remained really high for land in the tightly held northwest region and mixed farming land in reliable southwest region. Southwest Victoria led the charge in terms of median price per hectare, increasing by 14.3%. That was followed by the northwest and northern regions, increasing by 11.9% and 0.9% respectively. In contrast, Gippsland did actually experience a decline of 5%, and that was largely due to an increase in large grazing properties transacting in the Wellington municipality, which characteristically sells for a lower price per hectare, but is a reflection of improved seasonal conditions. Down to Tasmania, where we had really strong growth of 25.3%, taking the 20-year compound annual growth rate to 8.1%. And that's a reflection of the value of high surety irrigation land, and it's being recognised by buyers in the northern and northwest regions. It led to a scenario whereby demand outstrips supply, causing the value of farmland in these regions to increase sharply. The northwest and northern regions recorded growth of 26.7% and 21% respectively. In contrast, the south region did record a decline, and that is again due to a high proportion of lower value grazing parcels. So you can sense a theme here that grazing land was certainly transacting at a higher rate in 2020 across the country. Up to South Australia, where growth of 10.9% takes the 20-year compound annual growth rate to 7.2%. Prices hit record highs, and that's thanks to a low cost of funding and a strong appetite for expansion, where land remains pretty tightly held, much like New South Wales. Median price per hectare grew strongly in the central regions of the state, and York and North, and also Adelaide and Fleurieu, increasing 29.9% and 23.3% respectively. In contrast, the Eyre Peninsula recorded a decline of 8.5%, and the southeast region eased by 2.4%. In both regions, the drop in median price per hectare occurred due to a rise in the number of transactions in lower priced municipalities compared to 2019. Over to WA, and it's the second year of strong growth over in WA, growing at 19.3% in 2020. That lifts the 20-year compound annual growth rate to 6.2%. Above average soft commodity prices combined with record low interest rates were the key drivers over there. All 5 regions of WA recorded an increase in median price per hectare, which can be attributed to a greater number of smaller parcels transacting at a higher price. We did see strong demand in the northern and south coast regions, where median price increased 21.7% and 20.5%. Over to the Northern Territory. And important to keep in mind with the Northern Territory, we're dealing with a small number of transactions in 2 very distinct regions. So the top end region, which accounted for 86% of transactions, up from 67% in 2019. So at the territory level, median price per hectare increased 65.2%, and that follows a decline of 53.9% in 2019. So very much a rebound year there. Moving on to transaction volume, and as I touched on earlier, it's really important to understand transaction volume when viewing median price per hectare. In 2019, much of the country recorded an historically low volume of transactions due to severe drought. So anecdotally, we were expecting to see a large rebound in transaction volume, particularly on the East Coast. So let's take a look and do a quick rip around. The number of farmland transactions in Queensland increased by 20.1%. All regions recorded an increase, primarily driven by the south and central regions. In New South Wales, the number of farmland transactions increased by 24.8%, and that was largely in the cropping regions to the central and northern regions. In Victoria, the number of transactions increased by 10%. Gippsland and Northwest region led the way, increasing by 24.3% and 17.7% respectively. Down to Tassie, where buyers had to compete for a fairly tightly held market. So there's actually slightly fewer properties transacting in Tassie, decline of 2.2%, and that was mostly evident in the Northwest region, but also on King Island and Flinders Island. In contrast, the South region did actually see an increase in transaction volume. To South Australia, where the transaction volume actually declined by 1.4%, the Adelaide and Fleurieu region saw an 11.7% fall, while the York and North region saw a 4.1% decline in transaction volume. Interestingly, both regions in South Australia that recorded a decrease in median price per hectare recorded a fairly significant increase in transaction volume. So the Eyre Peninsula transaction volume increased 17.2% and up 1.4% for the southeast. To WA, where the transaction volume decreased by 3.1%, remaining fairly tightly held over there, the eastern region recorded a decline of 23.7%, while the number of transactions in the central region actually increased by 13.8%. Over to the Northern Territory, and the number of transactions in the top end region increased from 20 to 25, while the cattle region of the territory declined from 10 to 4. Now, I think it's important for a bit of a demonstration of the level of detail that this report does step down to by profiling a region which really did surprise me in 2020. Anecdotally, I was expecting transaction volume to increase sharply in central New South Wales, and it did, but often when this happens, there's an influx of lower priced transactions, and you can actually get median price per hectare slip a little in terms of growth, but that just simply wasn't the case in central New South Wales. Transaction volume did increase significantly, driven by favourable seasonal conditions. And historically, when that happens, as I said, it does curtail growth. So the volume of transactions increased across all price ranges. Is proportionally higher above $6,000 per hectare, which was a large reason for the increase in median price per hectare. And those higher value transactions are actually spread right across municipalities. So really highlights that the strength of that market in New South Wales. But this type of analysis is replicated for 27 regions across the country. So for a little bit more context on the national number, I think we need to have a look at the national graph, which tells a really interesting story over time. So in the 90s, obviously farmland was appreciating at a bit of a slower rate than what it is currently. So it was actually going up by a 3.4% average per year. The landscape was quite stable in terms of supply and demand, and we weren't as globalised as what we are today. So relatively flat commodity prices when combined with reasonable seasonal conditions, generally speaking. From 2001 to 2007 is probably the first steep growth phase on this graph, and median price per hectare at a national level was actually increasing at 14.4% per year, which is actually higher than the current growth phase. Obviously, everybody on the call would be familiar with drivers in that period, millennium drought being one of them. Also, the Australian economy booming as mining took off, and there was some speculation in localised markets, particularly around WA. Commodity prices also trended higher on the back of a reduction in supply. So, interest rates increased in response to a growing economy, and from a transaction mix point of view, we saw a greater proportion of high value transactions during this period. particularly in areas that were less impacted by the drought, so they continued to transact. You also saw better quality properties hitting the market at a time when they probably wouldn't have otherwise. So all of that led to a fairly strong growth phase. And then we hit a period in 2008 post the global financial crisis where things actually flattened right off. So from 2008 to 2012, median price per hectare at a national level was growing at just 0.9% per year. Commodity price bounced around all over the place, and that was just simply due to uncertainty in the market, but also supply growth, like late in that period when the drought broke. Interest rates fell, but the level of uncertainty in the market remained really high. Probably the most significant observation here is transaction volumes dropping sharply. That's primarily in response to volatility in commodity price, but also driven by improved seasonal conditions post a period of high selling. And in 2013, we enter what is our current growth phase. So from 2013 to 2020, Australian farmland values have appreciated by 9.6% per year, a rate which, according to the old rule of 72, would see the median price per hectare double every 7.5 years. There are a number of things driving this current growth phase, and we will step into them shortly in more detail, but export market growth, particularly for beef and lamb during this period, interest rates trending lower and seasonal conditions improving, generally speaking. However, we know that severe drought did impact transaction volume in 2018 and 2019 in most states. The other factor that's pretty important to consider on this graph is scarcity. So you can see a point-to-point comparison of median price per hectare against transaction volume. It actually hints at an inverse relationship here over time. And that transaction volume has been gradually tailing off. It corresponds with a wider industry trend of decreasing number of farm businesses. In the interest of context, let's take a look at how farmland performs against other asset classes. So for a broader cross-asset class comparison, it's important to view Australian farmlands in the context of other asset classes. So in the year that was 2020, farmland demonstrated unwavering growth despite market shocks in other asset classes, and that's evidenced by this graph here. So perhaps the most important time horizon, I think, for me with a patient capital class such as farmland is to look at the 20-year compound annual growth rate and compare performance against other asset classes. And we can report that farmland as an asset class has not only grown at a rate comparable to other asset classes, but it's also shown a low level of volatility as evidenced by the previous graph. However, we know farmland is a specialist investment and requires expert knowledge to manage risks associated with operational returns.
Matt, if I can just jump in quickly there, I'm keen to know what the relationship is between commodity prices and farmland values. Where is that at, and what are the implications for farmers?
Thanks, Lee, and it's a really important question, and it does form part of new analysis for the report this year, where we actually track the relationship between commodity price and national median price per hectare. We step that down to state level as well, so that's available in the report. But we did this because anecdotally we were hearing that median price, price of farmland in general, was actually starting to deviate away from commodity price for what you can produce on the property. So we thought we'd take a look at this relationship. We've been tracking it for a number of months now, but you can see there's quite a strong relationship. So the commodity price index is weighted based on the gross value of agricultural production for each commodity. And Australia is predominantly weighted towards beef at 27%, grains at 24%, dairy at 9%, and then a mixture of sheep, wool, vegetables and fruit. The baseline for both commodity price index and the farmland values index is calculated using an average price between 2010 to 2015 in order to get a fair representation of price over time and help smooth out that volatility in any one year. But let's look at that correlation for a second. And historically, the strong correlation between commodity price and farmland values has existed for a number of years, but it has started to diverge. And that first became apparent around 2016, but really widened significantly from 2018 to 2020, driven primarily by declining interest rates and historically low transaction volumes. But briefly for context, and as I covered before, from a commodity price point of view, the periods on the graph, 2005 to 2007, you had drought causing commodity prices to increase, with grain prices reaching record highs. Between 2008 and 2013, obviously the GFC and widespread rainfall introduced volatility into both commodity prices and farmland values. Grain prices came off a record high as production levels improved. In contrast, beef and lamb prices were actually supported for a little bit longer as herds and flocks rebuilt. From 2014 to 2017, beef prices trended higher, driven rapidly higher by exports to China, the US and Japan, and lamb prices began a consistent growth phase underpinned by exports to the Middle East and China as well. So grain prices during that period actually settled into a relatively sort of consistent period, which actually led to a higher average price as well. But if we focus in on 2018 to 2020 and look at these key factors that are influencing this divergence, we got the official cash rate falling from 1.5% at the beginning of 2017 to just 0.1% at the end of 2020. That does a lot for buying power. If you think about a couple of drivers here that influence buying power and where it is today. Previous capital appreciation resulted in strong balance sheets, so you can't discount that fact that we're in a growth phase and things are growing. A sharp decline in farmland listings resulting in historically low transaction volumes across the country can cause median prices to increase as you've got fewer lower price transactions in the mix, and higher grain prices due to a short supply while livestock prices eased as slaughter rates increased. If we look at 2020 in isolation, seasonal conditions have improved, which led to an increase in transaction volume. Historically, when this happens, we know that it curtails growth in median price per hectare. However, it just wasn't the case in 2020. Instead, median price per hectare kept pace with the previous year, really reflecting those strong buying power factors across the country, which we'll touch on further. Collectively, commodity prices were stronger in 2020, and that's supported primarily by restocker demand and pushing livestock prices, in particular beef cattle. Obviously, depending where you are around the country, you could have experienced anything from a 30 to 50% increase in the average price of beef cattle. So that was something that influenced the commodity price index and pushed it higher in 2020, but obviously not closing that gap to farmland values. Looking ahead to 2021, and buying power remains strong, driven by low interest rates and historically high livestock prices, suggesting that the median price per hectare could continue diverging away from commodity price. But the panel will expand out on this relationship shortly, so please submit your questions into the chat window. Just to close off my presentation, the report covers 27 regions across the country using an evidence-based approach to explain the movement in median price per hectare. I encourage readers to view year-on-year results with the knowledge of compound annual growth over time, and something that you can do with the appendix table at the rear of each chapter, where we go down to municipality level also. So look forward to answering as many questions as possible. Thanks, Lee.
Good on you, Matt, and so much good information there. I'm sure it's going to prompt plenty of questions as we head into this second half hour shortly. But before we get there, Tom Russo is a member of Elders Executive Committee and is currently National General Manager of the Real Estate Division of Elders. A corporate lawyer and agribusiness executive, Tom has extensive experience in project managing large-scale asset sales and has overseen some of the largest transactions in Australian agribusiness in recent years. Now, Tom's previously been the chief executive of a specialist international law firm, and he knows more than a little about complex transactions. So to lift the lid on what's happening in the market right now, could you please welcome Tom Russo? Hello, Tom.
G'day, Lee, and thank you for the introduction. And Alex, thank you once again for an invitation to be part of today's launch event. I concur with your comments earlier in relation to the importance of this report and the importance of the industry having good, robust data to sort of test what we're seeing out in the marketplace and to make sound decisions. And what's great is that the data is showing us that our producers and our investors in our farmland market are undeniably being rewarded for their investment in the industry. The future of Australian agriculture is undeniably exciting, and I think there's probably no better indicator of that and of the confidence in the industry than strong farmland values, whether you like it or not. So hopefully today I can provide some insights into what is happening on the ground and what we're seeing happening in the marketplace, and maybe even have a crack again this year as I did last year at trying to figure out what might happen as we move forward. Everyone's talking about it. It's the buzz, the market's hot. And, you know, at the risk of sounding like a dodgy real estate agent, I can certainly confirm that that's the case. It really is a red hot seller's market. And it really is happening across most, if not all, agricultural regions and different market segments. So we're seeing price records continue to be smashed. We're seeing low days on market. We're seeing lots of off-market transactions occurring because there's just so much demand out there. And I guess our agents on the ground, the only thing that they're really lamenting at the moment is just not having enough opportunities to satisfy all of that buyer demand. And I've got to say, as a landholder, it certainly must be tempting to sell into that market. But the thing we're seeing as well is it's equally as tempting to stay in there and continue to enjoy these good operating conditions and good operational returns that it's wonderful just to see our industry experiencing at the moment. So look, I guess in terms of market segments, it's really hard to pick a winner. There's strong demand where Matt, talked about that high demand for good high rainfall cropping and grazing country, and we're seeing that. You think of Western Victoria, Southeast SA, genuinely explosive price growth, so much demand for country through there. But we're also seeing that in other segments as well. So I'm seeing at the moment a return to strong interest in the horticultural space and in particular horticultural development assets. And I think that's picking up as a result of our water markets normalising post-drought conditions. We've seen some really good, robust transactions in northern pastoral holdings, and I think that reflects the record high commodity price, the northern cattle price up there, and confidence in the industry. Vineyards were unbelievable in sort of 2019, 2020, off the back of enormous export market growth, strong grape prices. Particularly in super premium regions, and we've seen a bit of the wind come out of the sails there as a result of China's view on tariffs there, or imposition of tariffs there. But watch that space; it's an interesting market. So look, boom markets everywhere. So the question on everyone's lips is, has this market peaked? Are the prices unsustainable? When are the prices coming back? And during this event last year, I tried to unpack a few of the key drivers around that and talk about whether we can expect this to keep happening. And the fundamental question really is, can we expect anything to shift this supply-demand dynamics that we're seeing, to rebalance this? Because fundamentally, pricing in a real estate market really depends on the balance of supply and demand. So you need to start thinking about to try to take a view on what's going to happen moving forward. Well, what is happening with supply and demand? And I think everyone knows a lot of the fundamentals. Everyone that's watching this market understands it pretty well. So I won't go into it in detail, except to just quickly reinforce that, on the buy side, we're still seeing incredible market sentiment. So, and I think that's really underpinned by the global mega trends that are creating insatiable demand and forward-looking confidence in relation to all of our agricultural commodities, and that underpins the high commodity prices. And what it's doing is it's driving a demand response, and people want to invest in participating in that supply response that our industry is currently undertaking, and that is being aided by uplift in productivity, and that's through seasonal conditions, but it's also through industry innovation. So, putting it simply, both productivity but also profits are moving in the right direction. You then need to think about cost of and access to capital. So what I mean by that is, how cheap is money and how easy is it to get? We all know that money's at a historical low in terms of cost. Is it still easy to get? I would argue it is. Banks, whilst being responsible, clearly continue to see our sector as a safe haven. They're happy to back in the right people who are buying agricultural assets. And there's also sort of no shortage of institutional capital looking for exposure into our growth story, into our industry. And primarily now that is through a very mature agricultural funds management industry that we had here, that is led by reputable players, people with strong track records that can continue to attract new capital as a result of delivering good outcomes to their investors in the past. So as a result, we still see a strong weight of capital looking to find a home in Australian ag, and that's both by local producers, private operators, corporate operators, institutional investors. So when you see that buyer side, those dynamics happening, you then need to turn your mind to the sell side and think, is there anything that's going to happen on the sell side here that could change the dynamics. And I can say we're certainly not seeing many forced or distressed asset sales in the marketplace at all. It's the contrary. Many owners are actually sort of grappling with the notion of, do I sell now or do I hang out here and continue to enjoy a lot of these strong operational returns? Then Matt talked a little bit in his presentation about liquidity, and last year I said, we came off a year of almost record low transaction volumes, yet we still saw price increases. And I said, is increased liquidity, particularly as we come out of the drought, going to impact prices? And in this year's report, we look at it and we see that we've had a 14.5% increase in transactions. I know in our Elders farmland business, we actually had a 25% growth in our farmland agency business. Year to date this year, we're seeing 10% growth relative to the same time last year. So I'm suggesting increased liquidity is still happening even as we move through this year, but prices are still going up. So I don't think there's enough increased liquidity on the sell side to impact prices either. I think the other way to look at that supply issue is, unlike skyscrapers or shopping malls or apartment complexes, the last time I checked, nobody had figured out how to just go and build new farmland. So it's a finite and it's a very valuable resource. So I can't see liquidity impacting the market globally. Perhaps in some narrow or geographically defined circumstances that Matt touched on, we might see that, but not at all in the overall market. So I think when you consider all that, you then need to come to a final question. And I think this is the ultimate question that the industry is asking itself right now. And that question is, are we reaching a point where acceptable returns on investment will not allow people to continue to acquire properties at ever increasing prices? So really it's willingness to pay. How willing will this market be to continue to pay these prices, these increasing prices? Last year, I proffered a view that I said I think we'll see only subdued growth because of this reason. I'm happy to say I was wrong. I'm rarely wrong, just ask my wife. But I still believe that this remains our critical question. And so moving forward in the year or two to come, I think what's going to be the interesting thing to look at is, are we going to see people say, look, I can't generate an acceptable return here at these prices. I'm stepping out of the market and I'll wait to see what happens. Where that point is remains to be seen.
And that is a really good point to finish on at the moment, Tom. Thank you very much for that. These are just extraordinary numbers, and again, some of the things that you were quoting, I've got to say, are a real surprise in a very pleasant way. Let's get into questions now, and just remember that anybody who's on this afternoon can ask a question, and we encourage you to do so through the question and Q&A system, so please do so. If you see something in there already that actually resonates with you and you'd like it, please formally like it, and we'll get to the most liked questions first. Now let's get into the questions now, and Tom, I think I'll go straight back to you, because following on from what you've been saying, it begs the question, are you seeing instances in the market where buyers, and maybe particularly the corporates, are stepping out, or are there signs that the market may be cooling at all? What do you think?
Look, it's a good question. I would have to say, as a general rule, no. Across the industry, in most sectors and in most geographies, no, and the data that's coming through that I monitor in our business is probably a good testing point for that, where we're still seeing a lot of increased prices, increased transaction numbers, and agents anecdotally just saying to me, I just cannot get enough stock, Tom, to meet this demand. I would say that we probably are observing isolated instances in perhaps certain parts of the market, and I can probably I'll give you some real life examples of feedback that I've got recently in the market that probably answers the question best. And for example, a couple of weeks ago, I was talking to a CEO of one of the most significant agricultural fund management firms that have been operating in Australia for a number of years. And that person was saying to me, identified a few key row cropping areas where, they had been looking to deploy capital and had, established a position. and just saying to me, look, sorry, we're out of the market at the moment. We just cannot accept acceptable operating returns at these prices. Our investors are not going to be happy with it. So we're disciplined investors. We're stepping out of the market and we'll look elsewhere. You know, I think we're also probably seeing on that front a change in strategy from particular operators as well. So I can think of, say, Warrakirri. So Warrakirri are well known to everyone. They're a well-established business. They've got excellent managers. They're a very disciplined investor, and that is why they continue to attract capital. You know, if you look at what they're doing, they're actually changing their strategy and raising funds to invest outside of their traditional broadacre cropping space, and they're investing into other areas of ag where perhaps traditionally they haven't. You know, perhaps horticulture or agricultural development opportunities, areas where they can see that they might be able to generate higher operating yields, or they might be able to invest capital to improve properties to create greater productivity and generate more returns for their clients. I'm not saying they're stepping out of the broadacre cropping space. I'm just saying to you that, you know, they are looking at ways to grow their business, but also ways where they can use capital more efficiently to generate good returns for their clients. I guess probably the final observation I would make is I reckon that this market is really playing into the hands of the established producers in regions, and particularly the neighbour. And it is really the year of the neighbour from the point of view of agricultural farmland transactions. And so firstly, the reason that's happening is because neighbours can achieve economies of scale, and they can leverage existing sunk capital and their existing cost base to achieve higher yields. So they may not necessarily get a high return on capital for the additional land that they're buying on a standalone basis, but on a productive unit basis across their whole holding, you know, on a return on DSE or return on you know, per acre, they're actually achieving an uplift overall, and this enhances the value of their overall holding, and so therefore the investment makes sense. They can afford to pay more than, say, someone looking to enter the market for the first time. I've also observed that those operators can sometimes take, I guess, an averaged out view on the pricing across their portfolio. So they might actually concede, look, I'm paying more than I would like to pay for this land, but I've got a multi-generational view. I've got succession issues I want to deal with. We're going to be here for a long time, so I can afford to buy this block at a price that might be a little bit higher than I'd like, but averaged out, I'm still way ahead and I'm doing well and I'm achieving economies of scale. Hopefully that answers that question, Lee.
That's a very comprehensive answer, Tom. It makes me think of a number of things. The point that you finished up on, neighbours essentially being probably the drivers of what happens in future. Alex Gartman, what about farmer buying power at the moment as you see it? I mean, we've got low interest rates, commodity prices generally are pretty good, people have got equity. The cash flow environment at the moment, what do you make of farmers' current buying power position, Alex?
Thanks, Lee. Look, as you've heard from Tom, and Tom is exceptionally articulate, so I don't know that I can say it better than he has, but buying power remains strong, and it is driven by low interest rates and historically high, particularly livestock prices, and generally solid commodity prices, suggesting that median price per hectare could continue diverging away from commodity prices. So this positive trend in commodity price is underpinned by really strong export demand and a growing domestic market. If I reflect on it and think about interest rates, they will really need to rise a lot to see much impact in cooling the market. They are so low, it will take numerous increases to achieve a significant quantum of overall increase. And that's really likely to be over an extended period of time, so a couple of years. As you'd expect from a bank, we are testing lending against higher interest rates and looking at how P&I repayments respond over, say, a 15 or 20-year period. And we're comfortable. We are comfortable with the industry and where it's at. And I think cash flow, if you look at agricultural cash flow, it's also demonstrating farmer preferences from paying down debt, which many financial institutions are seeing, or investing for growth. And that investment piece is now, is it the agricultural land, the neighbour land, or is it a different piece of land that spreads your climate risk, or is it further into the value chain or other completely different asset classes? Now, traditionally, seasons have not dramatically impacted farmland values in the short term. For instance, land values in Victoria grew strongly through the really challenging millennium drought. And if I think about improved management practices that have been developed in response to drought and climate variability, such as soil moisture retention or increasing soil carbon, clay top dressing, exclusion fencing in Western Queensland, high water efficiency varieties of grain and irrigation schemes, they all point to how the industry is really investing in new knowledge and technology. And that may not seem obvious, but it is a factor that's dramatically improved how farmers manage risk on both marginal land, but also highly productive irrigated land. So it's giving confidence to farming areas, for example, in Western Queensland and Mallee and Tassie in the irrigation schemes, which we may not have had previously. So when combined, it basically means that a bad year 20 years ago isn't as bad today in some cases because the risk can be managed or better managed. But again, as a bank, you'd expect us to be cautious in our outlook, and we are sensitising performance and production on a year in, year out basis to make sure that we don't get caught up in hype and that we're really looking at facts and data and numbers. Seasons are the hardest thing to predict, even though there are better and better seasonal forecasting tools. And as those forecasting tools get better, many are modelling the impacts of long-term climate change on regions and commodities, and we are as well. We're trying to better understand those regions, or even some of the operating models and gearing levels that will be put under pressure under different climate changes. So we're seeing at the moment some of the best risk grades across clients in our book for many, many years, and it is reflective of the equity values that those higher asset prices deliver, because farmers are in the land business as much as in the production business. And land appreciation over the last 5, 10, 20 years has added a large amount of equity to balance sheets at a time when the supply of property, as Tom and Matt have both pointed out, is very tight. So this means we've got high buying power and lots of farmers ready to buy, but we've got such a small pool of sellers, resulting in that strong competition for anything that lists. And I think that trend has longer to run.
Thanks, Alex. Tom, I'm really interested in, the market is hot at the moment, and sometimes people really fear about missing out when things are running so well. Is there any danger that there's emotion creeping into this and people aren't making sound decisions? So, effectively, do you believe that the market's inflated, or is it at unsustainable levels at the moment? What do you think?
Oh, you're asking a real estate agent if the market's overpriced, Lee. I might lack a bit of credibility there, but no, look, it's a really good question, and it's one that I hear all the time. At barbecues or over a beer. It's obviously the question that everyone wants to know, and people talk about all these crazy prices, and people are insane, and all of that, and so there is all of that noise out there. And I think definitely there is a situation where people are probably lamenting or getting frustrated that they're not able to acquire that farm that they want. And so then they miss out a few times, and then they end up throwing everything at it to try to buy that farm and break into the market. And yes, we see those things. I just don't think it's accurate though to draw from that observation, a conclusion that the market is overheated or unsustainable. And I think that it probably comes back to a lot of the issues that Matt was touching on in his presentation. And that is really, when you think about it, it's driven by two things. It's driven by productivity and it's driven by profit. And the more profitable the industry is, the more people can obviously invest in the underlying assets and then still achieve an acceptable return. And that return can be a blend of both operational yield and also capital growth, right? So you can actually take a big deep breath and go and look at some data and that puts that all into perspective. So you can look at data, for example, that will say that from about, I think, 2007 through to just before the drought, we saw about a 500% growth in broadacre farm cash incomes across Australia, which is extraordinary. And then the drought hit, and now that we're coming out of the drought, the government is saying that they're thinking that there's going to be an improvement in farm cash incomes again in 2021 by approximately 18%. So farms are becoming more profitable. Therefore, people are able to invest in the underlying asset and pay good money for it and fair money for it. In the cropping industry this year, with the increased productivity and the better seasonal conditions, we're expecting about a 37% turnaround in cash returns on those farms. So look, farm incomes are rising, commodity prices growing largely, and it's largely been tracking in line with farm values. Matt makes a valid point that there is a bit of a gap that's opening up there. I would probably argue in response to that low interest rates and higher productivity levels will offset that. And I guess finally, I think Alex mentioned this at the start, when you look at farm management deposits and when you look at debt and equity ratios in our industry, on average, they just haven't moved. Farm deposits are going higher, debt to equity ratios are staying at good levels. They're not in any way getting anywhere near dangerous levels. So from my perspective, I'm saying things are becoming more profitable, and collectively our farm balance sheet still has a lot more firepower in it.
That's encouraging to hear. Matt, I'm keen to go to you. What's your view on this, particularly given climate change and or variability? What do you see as the implications for those who are paying these high prices, and do you think that they can secure a return on their investment going forward?
Yeah, I think it's a fair question, Lee. I think I can answer based on the confines of the report, obviously, which definitely doesn't cover the much broader issue of climate change. However, I think you can break it down to risk management, and that's something that's worth unpacking. Growth in farmland values, it isn't confined to climate zones. That's the first thing to understand. Whether you're in West Queensland, the Mallee, or Northwest Tasmania, you can get capital growth anywhere, and it's for a range of reasons. Yes, the risks of production differ in each one of those, and that is reflected in the price you'll pay for the land, but not necessarily how much it will appreciate over time. I think that's important to understand. The similarities with each region is the ability to manage risk on farm. I think managing risk probably 20 years ago, it's very different to managing risk today. An average year today is generally better than an average year 20 years ago. Things like soil moisture retention, improvements to genetics, exclusion fencing, West Queensland as an example, clay top dressing around Tilapia Downs in the Mallee, and investment in irrigation schemes in Northwest Tassie. They're all things that form part of this continuous improvement, which improves profitability. And if it doesn't rain, obviously nothing grows, but if the ability to improve water use efficiency exists as an example, it can change production value of that land, and wherever you're located, that can happen, and it can drive growth in farmland values. And I think we do see that across state to state. To answer the last part of that question, we know investment into farmland is a long-term game. So to view future returns, it differs from individual to individual, but perhaps a better way to phrase that question is what are the implications of not buying today? So you've got strong underlying demand for commodities, proven capital appreciation over time, and continuous improvement in an industry. It makes a really strong case. Can farmers secure a return on investment? The situation in economies of scale, and I think Tom's sort of touching on this, it differs from farm to farm. However, the fact that the market continues to rise around the country suggests that yes, a return is very much achievable, and it's underpinned by things like strong demand for Australian food and fibre, and that's evidenced by that commodity price index trending up over time. And the continuous improvement in risk and cost management, low interest rate environment, it all contributes to achieving a return on investment.
The question that seems to be getting the most interest from those who are asking at the moment is the one that I want to go to now, and I might ask each of you actually what your thoughts on this might be. The question says, can you please comment on the relationship between lease costs and farmland prices, and at what point lease prices are not sustainable? Matt, perhaps I'll begin with you.
Yeah, look, we don't look at lease prices specifically in this report. I mean, anecdotally, you know that the old rule of thumb being 5% doesn't apply anymore, and that is a function of land values going up. So I suppose I can't really answer it whether it's something that is sustainable or not. I'm not sure if Tom's got any views or any evidence to sort of point to from a real estate point of view.
What do you think, Tom?
Yeah, look, I think there's definitely a squeeze in margin is probably a good way to describe it. So the issue you have is that money's so cheap that how can you justify high lease rates in this market? Because it's better for people to just go out and borrow the money or invest their own money. So you can't demand, say, an 8% lease yield anymore, and particularly in, say, certain market segments where operating yields are already more marginal than others. So, for example, in northern cattle, you're not going to see people willing to pay a 5 or 6% lease rate versus, say, people leasing a mature permanent tree crop. They might be saying, yeah, 5 to 8%, it still works for us. So it depends on industry segments, but I think that the critical issue is money's getting so cheap. How on earth can you justify high lease rates, except for tenants who perhaps don't have the financial wherewithal to raise their own capital?
Now, unfortunately, we're almost out of time. It's it's the same old story. When you're having fun, time just flies, and it really has with this report today. Before I ask each of you just for some summary comments to bring things to a close, Tom, I just want to ask you about your thoughts about the sustainability of all of this. I mean, in your view, has the market peaked, and are these prices sustainable? Is there an answer to that?
So Lee, you may have did you just cross to me? And if so, I actually lost the connection there for a second. You might want to repeat the question if it was directed to me.
I think we may have actually lost Lee.
What was Alex? Was it a question to me about sustainability, or
yes, whether or not you believe that this is a sustainable increase in environment that we're in?
Yeah, and I'm probably a bit more bullish on it. I'd say it is, and I just think it's because productivity and profits are going up basically, and I would probably also remind people to think about go back to basics and think about the long-term outlook here. We have every reason to be super confident in the industry. The global megatrends say that increasing populations, middle class incomes driving growth for our produce. Think of some numbers. Asian populations hitting 5.3 billion people in 2050. ABARES is saying that of those people, in high income countries, they'll triple by 2050. So that's about 3 billion new consumers that are adding to that high income group by 2050. And then the World Economic Forum comes out and says, that middle class populations are going to expand to be 70% of ASEAN populations by 2030, driving a doubling in consumption. And these are all nations on our on our doorstep. So, for me, that's a lot of extra mouths to feed, and participating now to invest in that supply response is just a very exciting opportunity indeed.
And Lee, if I can jump in there, sorry, Lee, I am going to sort of push you on time, but Tom's responded to that, and he's really bullish. And whilst I've got a really strong positive outlook for Australian ag, you'd expect from a bank that there'd be a note of caution in there. And I have to say I'm really pleased and in admiration that the consideration our clients are giving to the outlook. So many family farms are very aware of the strong drivers and slightly concerned about where that separation between commodity price and farmland values and where it's going. But it is part of the thinking and part of discussion with their financial advisors and others. And the neighbouring property's always been valued higher than a property anywhere else, and I don't think that will abate. But investment is being considered in other areas, not just in farmland values, although farmland is a great place to put your money. And I think there are many influences in our industry positive at the moment and bullish, like Tom's outlook. And we should enjoy the benefits when they're here, but at the same time, flashing lights here, we need to start planning for that next phase and preparing for the next drought or market adjustment, because we all know that we should be drought proofing or strengthening our business while times are good, but we often don't get around to it. So I think the fundamentals are there. Like Tom, I think it is sustainable, but it's when things are all going really well that we need to position ourselves to weather through any of the hiccups and challenges that will inevitably face us as an industry.
The old saying, make hay while the sun shines. And another question that's attracted a lot of interest comes from Ross Kingwell. He asks, as farm size increases and farmland remains tightly held, do you think that land scarcity will increasingly place upward pressure on land prices? What do you think, Matt?
Yeah, definitely. I think that's evidenced by the national graph there, where you can see it happening since 1995. I think we've got a larger pool of buyers and a smaller pool of sellers, and that's a trend that's going to exist for a number of years yet. So I think that scarcity factor is definitely something that's going to keep some excitement in the market for sure.
Would you agree, Tom? And I guess you're always on the hunt for more properties, especially at a time like this.
Oh, look, yeah, I could show you a whole lot of data which suggests that the trend is absolutely right. You know, we're moving to a situation where there's fewer farms, but farms that are bigger. And again, it's just being driven by economies of scale. You know, typically the bigger the farm, the more economies of scale there are, the better your margins are, the more profitable you are, and therefore the more valuable your farm becomes. So I think that, as I said earlier, you can't go and build an apartment complex that is farmland. You know, you just can't create more of this stuff. So you know, if we see lower transaction volumes, or if we see, you know, more farms, less farms but bigger farms, well, absolutely, it's going to mean that there's less opportunities for people to buy farms, and that's going to put pressure again on the supply.
Well, we're pretty much out of time, so if I could just throw to each of you in succession now, and I'll start with you, Matt, just to give us a final summation, your message that you'd like to go out as part of this report for 2021.
Well, I think my favourite stat's the 20-year compound annual growth rate of 7.6% nationally, and if you look at the report, that's replicated and exceeded again and again at local level, and it's great to see commodity prices are trending higher as well, which is underpinning that confidence. But I would reiterate what Alex is saying around being cautious and the need for a culture of continuous improvement, if you like, in every facet of agriculture. I think it's something that we need to understand, that the next challenge is just around the corner. So the more work we can put in up front, the better we'll be positioned for growth going forward.
And Tom Russo, final thoughts from you?
Look, I would just I echo those views, but I guess I'm always glass half full. I think we've got every reason to be confident, every reason to be excited. It's a wonderful time to be part of agriculture. I think the more we can innovate, the more we can increase productivity, the more valuable our farmland will be. And I think that investing now to participate in this supply response and these targets that we have as an industry to grow productivity is just a super exciting opportunity. So go out and buy yourself another farm through your trusted Elders agent tomorrow.
I'd love to be able to do that, Tom, let me tell you. And final word from you, Alex Gartman.
Thanks very much, Lee. Look, I've heard it stated in many industries that data is the new gold, and I think it's the same for agriculture. Our industry is maturing and leaning in to have conversations earlier about what the data and the trends and the insights are telling us, which hopefully reports like this feed into, providing data to really inform those perspectives, the analysis, and importantly, the decision we are making. So we operate in a land of extremes. We've got droughts, bushfires, floods, COVIDs, and that's hopefully COVID singular. And that's really just in the last 18 months. And there are many regions and localities that are recovering from really devastating impacts, not only in the last 18 months, but the last couple of years. And we have to acknowledge that, you know, whilst there's some really positive data here, individual businesses, individual locations have not experienced this all in the same way. And trends, local ones like what Matt's highlighted in the report and the mega trends that Tom referenced earlier are continuing. We've got demand for commodities, farms are getting bigger, climates are changing, productivity is increasing. And I think technology and complexity of business management is still really evolving, and capital's available. So all of that I think bodes well, and I, like Tom, I'm a glass half full, and I think there are lots and lots of opportunities in Australian agriculture. And some of the things that we view as threats, like climate change, yes, it's a threat, but I think it's not always the full picture. Matt spoke earlier about farmers getting better at managing risk, and this will need to continue, extracting productivity from every single hectare. But we aim to do that for many reasons, because a profitable and sustainable farm can invest in preparing for the bad times. It can invest in improving the soil and landscape condition, invest in really harnessing carbon within the system and adopting and innovating practices and innovations. So we need to ensure we're planning with good risk management tools, because there will be a perfect storm that impacts us at some stage down the track for either our individual businesses or the communities that we innately rely upon. And as I said earlier, I'm really impressed with the level of discussion that clients are having on the potential challenges and risks that their business are facing and what they could do about that. But we need to make sure that continues across the value chain, and it's not just inside the farm gate that we're having those conversations. And we need to make sure, and it's something we haven't touched on today, but I know was touched on by Will Rayner in the Landline feature on Sunday, we need to talk about what this does to barriers that hinder the best and brightest minds being occupied by agriculture and getting into the industry. So we do need to think structurally about how we structure our businesses to bring new and younger talent in to support these really evolving and ever more sophisticated business operations. So I think there are lots of opportunities given the need for quality, consistent food sources and produce the right way, adhering to environmental and social values. And I note there are a couple of questions in the chat around carbon and what are some of the future drivers for farmland values. Now, there's no really defined carbon market at the moment, so that's not driving farmland value, but potentially, as I was with the Minister for Ag in Victoria yesterday, talking about opportunities for emission reduction technologies and practices and carbon farming, that is something that could be a future driver of farmland value that really adds to this data set and is another factor that we're talking about. So that's exciting, even if it does keep us on our toes every other day. Thanks, Lee.
Thanks, Alex, and thank you to Matt and to Tom as well. And on that very positive note, that concludes today's report. It is the source of farmland values in Australia. You can explore the report and find out the trends in farmland values either across the country, the whole country, or in your own region. It's all there. Remember, it draws on every farmland sale for the past 26 years. That is extraordinary. So it's a conversation starter. Please seek out a rural bank relationship manager in your area to talk through the implications of strong farmland values. They'd love to hear from you. And finally, I recommend checking out all of Rural Bank's publications at the Insights tab on the Rural Bank website. So thanks again to our speakers this afternoon. Thank you for participating. I'm Lee Radford. Good afternoon.